Thank you everyone for joining this first session. The topic of the webinar is business interruption claims for cannabis enterprise. Now, what is business interruption, or most importantly, what is this webinar not about? This webinar will not be focusing on economic damages or calculation thereof, or the various types of insurance coverage. This presentation is going to be focused on providing an overview how lost revenues are calculated as a result of a business interruption event that results in the economic loss to the cannabis proprietor. The economic loss will be results as an outcome of the act of God, or for the agnostics, higher power, or for the atheist, shit luck, basically, that an enterprise suffers and then has to subsequently file an insurance claim to demonstrate what losses would be subject to coverage. Now, a little bit of a legalese. Nothing covered in this presentation should constitute legal, tax, or insurance advice. I'm not an attorney and I'm not an insurance agent. And for any specific insurance coverage claims or any ongoing issues, please contact your attorney, your tax CPA, or your insurance agent. It's very important to know which parties are involved in the business interruption claims. So obviously there are business owners, the cannabis proprietors, there are insurance adjusters, there are licensed public insurance adjusters, there are attorneys for the business, attorneys for the insurance company, and obviously CPA, ABV, and CVA professionals who are engaged by the either business owner or by the insurance company to estimate the suffered loss of revenue and file the claim, or alternatively to challenge the estimate thereof. What would be typically involved for anyone in the industry involved with the business insurance claims? So obviously there would be a site visit, there would be an analysis of historical and prospective information, there would be financial projections, and there would be an assessment of revenues and expenses. Now, before we delve too deeply into the topic, let's discuss what is business interruption insurance. It really is an additional property insurance coverage that covers specifically loss of income if the business suffers a loss qualifying event where the premise is unusable for a period of time, or the business really has to relocate to an entirely different area. Now, based on the global claims analysis, the leading causes of the property insurance claims, or the business causes of the business interruption claims, are obviously fires, collisions, storms, defective products, water damage of various kind, and machine breakdown. Interestingly enough, earthquakes are not included in this list because earthquakes are covered by an entirely separate insurance type. The intent of the business interruption insurance is to keep the business solvent while the restoration is ongoing. However, the details, the devil is in the detail, as they say, and the details of each specific insurance policy are very specific and customized to an extent, and we'll talk about it a little bit later on. Now, the business interruption claims typically covers the following. It covers lost income, which is calculated on the basis of documented, and I want you to stress this word, documented sales records and profits earned during a similar time frame that the claim is being filed for. It also covers operating expenses that are meant to be relatable to the economic activity of the business. It all obviously covers payroll. It covers temporary operation of a temporary location if the existing location is unusable for a period of time, and therefore it covers certain fixed payments such as mortgage payments, lease payments, moving expenses, etc., etc., which, by the way, is separate and distinct from the economic damages, where fixed expenses are not taken into consideration. But we're not talking about economic damages in the sense of estimating what those are. We're talking about the damages suffered by the operator for the insurance claim purposes. It's a very important distinction here. Some secondary and incidental costs, such as training costs, commissions, and obviously taxes. Taxes, you have to pay the taxman, whether you are in operation or not. And the business interruption insurance claim does cover tax payments, which we will go into a little bit more detail later on. Now, the important point to keep in mind here is that the business interruption coverage requires accurate projection of revenue and expenses for the covered period, and an assessment of how long it would take to restore damaged property and return to the normal operations, and we'll talk about it later on as well. When speaking about the business interruption insurance, it's very important to be specific as to the definitions. So actual damages refer to the actual suffered damages. Not possible damages, are not speculated damages or expected damages, but actual damages that are based on the historical sales and revenue records. Business income includes net income, net profit, or losses before income taxes that would have been earned or incurred had there been no loss qualifying event. Suffered losses refers to the actual reduction in net income that results from the suspension of operations, partially or wholly, due to the loss qualifying event. Disruption means that impact on the operations that prevent the business from operating normally. An important definition here is the extra expense, which incorporates the unavoidable expenses incurred by the business that would not have been incurred in the normal course of operations, but for the loss qualifying events. And the example of the extra expenses, additional utility bills, or moving expenses, or anything and everything that's outside of the normal operation. Later on, we will work through an example and we'll go through some of those extra expenses. And obviously, operational disruption is defined as the impact on operations which prevents the business from operating normally and results in a partial or full cessation of the operations. Right. Now, a little bit of a graph here, and I know, Renata, you love graphs. That's the one and only graph that we have for today. I just wanted to demonstrate visually what is involved, what is a loss event and how a loss event impacts operations. So on the two axes of revenue and time, the solid black line represents operations pre-loss qualifying events, and then the operations post-qualifying event. So the whole focus of the business interruption insurance and the whole focus of where we are involved is to estimate accurately the delta between the but-for operations and the post-loss operations, and to denote and to accurately calculate what the delta is. Now, we are talking about the cannabis enterprises, right? I guess that's why everyone's here, otherwise you're in the wrong committee. And there are some specific cannabis insurance considerations that are very important. Now, what are those considerations? Well, obviously, given the different legal environment across different state lines, and given the different life cycle in the cannabis operations, there are specific considerations that operators need to be aware of when getting the business interruption insurance. So, for example, what are those specific risk factors that are present in the operational ecosystem of a cannabis operator? Cannabis growers primarily would be interested in, primarily would be focused on protecting their crops or gathering and processing equipment, and a loss of raw product that was harvested prior to being processed. that entails, for example, coverage due to pests or coverage due to flooding, the fields are flooded, or coverage due to disruptions in supply chain. You can't get the fertilizer, right? Those risks are very distinct from risks focused by the cannabis processor, which is primarily focused on protecting the facilities, protecting the distillation equipment, and protection of work in progress inventory from contamination or from, again, spoilage. And those risks are also quite distinct from what the end stage cannabis operator would face, let's say dispensary, which will focus primarily on protecting their retail storefront, protecting the final product inventory, protection of storefront operations. And there, the insurance considerations would be different as well, and therefore, the specific type of coverage that would be required would be different. Now, the world of insurance for cannabis operators is somewhat disjointed because of the ongoing legal issues, and because the cannabis is not legal federally. The large insurance companies do not operate in this field, and therefore the field of insurance for cannabis operators is primarily made up of smaller underwriters who specifically focus on cannabis enterprise and who are able to customize their insurance coverage. However, that does result in certain higher costs and certain exclusions to the to mitigating those losses. Again, we will specifically go through that, but what I wanted to really point out here is that there is no standard insurance business interruption insurance coverage for cannabis operators. It's very well customizable, and an insurance underwriter in a given geography might not even have a standard policy wording that would be applicable across. The specific riders might be, again, very specific to each type of operator in that geography. It might be specific to the dispensary, it might be specific to the grower, it might be specific to the processor, and so on and so forth. Now, there are some very...
Again, I'm sorry to interrupt, but is it okay if I ask a question on the previous
Sure,
slide?
sure.
Can you go back? So the cannabis growers, right? You mentioned in your previous slides that there is a revenue line, and then, there is an interruption event, and then, we have to calculate the delta. I have a client in upstate New York who's a cultivator, and they were about to do their first sell, and then the flooding happened in upstate New York. He lost a lot of crops. Now, is it something that business interruption insurance can be provided to somebody who's about to start the operations, or you actually have to be in operations?
But estimate of lost revenues is predicated on having the historical track record of what those revenues are for the period that the insurance is being filed on.
Okay, that's clear. And then on the next slide, under the dispensaries, like what's important to protect for dispensary, I see you have cash handling procedures. Can you a little bit elaborate on that? How a cannabis dispensary can put that into the insurance policy to be protected? How? Like, is there what kind of issue potentially can come up that they are eligible for the protection?
Sure, that's a great question. The world of business interruption insurance is very detailed. The policies can be quite strict and specific, and a good example here would be a rider in the insurance policy that expects a business dispensary to have operating procedures on safe cash handling that would have established certain safeguards and controls to prevent theft of cash. Because if there isn't such a policy or the desktop procedure, if there isn't such controls, then the insurance company can claim that the business owner did not attempt to mitigate potential losses, right? I think I mentioned that at some point, but the mitigation aspect of potential losses, the onus is on the business operator. Therefore, if business operators, dispensaries can demonstrate that they've tried to mitigate potential losses through the operating procedures, through safe handling of either inventory or cash, it's one thing. If they don't have that readily demonstrable, then they run the risk of insurance coverage being denied.
Understood. It's pretty much similar to cybersecurity risk that, in order to have that policy, you actually have some, cyber security, I guess, protocols, work on the VPN and all this stuff, and then you're eligible for insurance. You cannot have a policy if you don't have a protocols in place, right?
Right.
Okay,
And
understood.
again, word of legalese, I'm not an insurance agent.
No, I get it, but you are CPA, so it's like,
Sure.
CPAs wear many hats. Like, sometimes, I'm getting asked also legal questions, so I just give it a shot. I thought,
Yes.
you answered
Yes.
greatly. Thank you so much. Continue,
Sure.
please.
Sure. So going back to the specific cannabis-specific, unique cannabis-specific considerations, we just talked about the policies, right? So, for example, policies might include coverage of revenue from the sale of inventory that is deemed as contraband. How can that be? Well, let's say a dispensary operator is located in a state where sale of cannabis products is allowed, and the distiller is located in a different state where distillation of THC, the production of THC edibles is allowed. Yet the inventory has to cross state lines where cannabis is completely illegal and sale of any cannabis is illegal. Therefore, by that definition, sale of that product will be deemed as a contraband because it had crossed the state lines and it went through a state where such products are illegal. Therefore, insurance coverage of the said contraband can be denied. Therefore, that's a very important point to be aware of. Additionally, proper licensing of premises. I myself have observed multiple shops being shuttered, at least where I live. I mean, in 3 block radius, 4 of them were closed overnight. Now, those shops were not properly licensed, and the insurance coverage, assuming they got an insurance coverage rider might be specific that operation of that premise has to be fully licensed and fully in compliance, or that products that are sold there, and we'll go through the example later on, have to be licensed and allowed. Let's say this business suffers a loss if through the due diligence it's established that they were not properly licensed, or that they didn't have a license to sell, or they only had license to sell edibles but not tinctures, and they had a distinct revenue stream for tinctures, well, that revenue stream will be disallowed and the insurance coverage will not cover it. And also everyone's favorite IRC 280, where the businesses in the cannabis field cannot deduct certain expenses for their tax purposes. Well, the insurance rider may demand that the revenues are restored fully in compliance with the IRS or FASB regulations for tax purposes, and therefore certain expenses that normally would have been reimbursable by any other business will not be reimbursable by the cannabis business. And we will go through that a little bit more in detail later on. Now, what's involved in projecting lost revenues? Well, it runs the gamut from very sophisticated simulations, so Monte Carlo projections, which I don't think anyone really uses, or it goes back to the historical record, either very simple averaging, or if someone wants to be a little bit more astute and a little bit more comprehensive, specific forecasting that is aligned to the type of a product, to the time in question, etc., etc. There is really no specific guidance or requirement on how to show restored revenues, except that the approaches have to be generally applicable and part of the accepted methodology. As a component of the business interruption claims, businesses have to show their restored revenues, but they also have to show the cost analysis. There are again a number of different areas, different approaches that can be taken. You could focus on your net income, you could focus on your sales and gross profit projections. The main point that I want to communicate here is that there is some flexibility in which specific component of the financial statements the focus is going to be on, but it is all based on the methodology to estimate these lost revenues, and we will go through that later on in the detail. Again, the only point that I really do want to stress here is that the cost analysis is part and parcel of the business interruption claims. Now, last but not least, I want to show, when speaking about the insurance, we talked about that the insurance riders, the insurance declarations can be very specific, and business operators need to know what they are dealing with. Insurance policy can specifically define what is the business income, what are covered extra expenses, what type of damages, whether or not premise is covered fully, partially, or based on the productive flooring. An example would be business has large floor, 1,000 square foot, but their sale registers only occupy half of that square footage, well then only half of the expenses associated with the storefront would be reimbursed because the other half is non-productive. Again, this is just an example of how detailed the insurance policies can be. The limits on coverage, the conditions, we talked about that, proper licensing, not selling contraband. What are the mitigating responsibilities? Again, business owners are obliged and required to mitigate potential losses. How losses are determined, whether co-insurance plays a part and to what extent, and also defines what is excluded from the business insurance coverage. Now, an important element of the business interruption losses is so-called period of restoration. Period of restoration is a time it takes business to restore and come to and restore operations to the most restorable state. That doesn't mean that everything has to be restored 200%, but it just means that the business can resume its operations as close as possible to the pre-loss event. Now, the business period of restoration starts from the date of the loss and ends on the date when the business substantially resumes its operations. The benefits covered by the business interruption claims are paid only during the period of restoration. Coverage typically goes out to 30 days or to the fraction thereof, and the period of restoration is predicated on documented and implemented timelines of repairs, right? Insurance companies do not want to drag out repairs unnecessarily. Business owners probably also want to restore the operations as soon as possible, which is why it's extremely important for the business proprietors to have a plan afoot on how they would potentially restore the operations. Some of the period of restoration considerations are whether operations are feasible at the impacted locations or whether relocation is required, what's the extent and the breakdown of the extra expenses, what's the extent of the avoided expenses and the breakdown thereof, have the business owners filed the claim in accordance with the stipulated timelines, and have they been involving adjusters and other professionals to restore or to calculate the revenues that would have been and that would be subject to the insurance claims. In connection with that, time is of the essence. Losses are limited by the period of restoration, and the period of restoration typically starts after 72-hour waiting period. most policies cap the payments to 30-day intervals or 60-day intervals, but usually not beyond that. If businesses get extended coverage, that might buy them additional time, again, but no more usually than additional 30 or 60 days. The period of restoration really determines when insurance will cover business income and extra expenses. And again, as I said, it ends when the damages have been reasonably repaired and normal operations have resumed. Resumption of the normal operations is subject to the professional damage and the insurance assessment. As I mentioned, the business has an obligation to mitigate losses during period of restoration, and that would be really indicative of doing everything possible to shorten the time period when the operations can be conducted. Businesses have to constantly communicate with the insurance company adjusters to ensure that there is no daylight lost and the timelines are being adhered to. Businesses must document all extra expenses incurred and must provide substantiation for all expenses and revenues, expenses incurred and revenues earned during the period pre-restoration. Again, this documentation aspect is very important. If businesses don't keep good sales records, if they don't keep and track all of the expenses, more likely than not, insurance companies will not reimburse them. And obviously, businesses have to provide, upon demand, substantiation of all extra expenses, etc., etc. Now, what would be involved, from our perspective, what would be involved in setting up the business interruption loss calculation? Well, you must demonstrate, if you are involved in estimating and calculating those lost revenues, you must demonstrate that you understand the business and that you must understand the operations of the business, right? That would entail a field visit, an initial discussion with the business. We would need to do our due diligence and document what the losses are. Obviously, we're not loss adjusters, but we will need to update and obtain estimates and the damages report from the loss adjusters. We need to understand the nature of the loss event and the extent of the damages suffered. We have to document how the business has been impacted and really gather all pertinent information, sale record, expense records, etc., etc., financial tax returns, to establish solid baseline upon which to rely for the purpose of restoring or calculating the restored revenues, so the revenues that would have been but for the loss event, and estimating the delta correctly. We also would need to review insurance riders. It's a responsibility of a professional working on business interruption claims to really understand the insurance specifications, the insurance rider expectations, exclusions, coverage limits, etc., etc. The approaches to loss income calculations are really, again, predicated on having good and documented track history, tax returns, financial statements, financial sales forecast, etc., etc. If forecast data, for example, is lacking or is not deemed to be reflective of the actual operation, then it would be incumbent upon us as professionals to create our own projection or forecast of what the revenues would have been, what the expenses would have been for the period of restoration if we don't have solid information, or if we don't think that business is in a good position to provide us that information. Now, there are, broadly speaking, two general approaches to estimating lost revenues. There is the net income approach. Starting point is the net income, which already includes all expense information. It is more detailed, and it does require assessment of each and every expense. Therefore, it might not be as straightforward or as intuitive. And the second method is the gross profit method, which is simpler and more intuitive, relies on the forecasted revenues, but It is predicated on the established history of operation. Renat, I think this goes to your point. So if this is a brand new business that does not have 3 years 3 years worth of historical information, then the gross profit method probably will not be applicable. I do want you to say that insurance policies often stipulate which method would need to be relied on. So check your insurance policy. Now, right. So going into the details of the net income method, also known as the bottom up, because we're starting from the bottom. This method is typically used for enterprises that have suffered irrecoverable losses and have to shut down, or that cannot resume operation in the old facility and have to relocate. As mentioned, the primary focus of this method is on expenses. The broad structure is that you start with the net income. You would add your continuing expenses, you would add your extra expenses, and that would total up to the business interruption loss that the insurance company would need to pay out, right? You've identified your lost revenues, you've identified your offset by the continuing expenses, you've identified your extra expenses that need to be reimbursed, and that adds up to your potential loss. The second method is the gross profit method, the top down. You start with your not forecasted or restored revenues. You would subtract your continuing and variable expenses. You would add your extra expenses, and that would total up to the interruption loss that the insurance claim would be filed for. Any questions before we proceed? Because I want to go through the example. All right. So let's work out an example. We have a cannabis dispensary. Please allow me the literary license, Up and Smoke Incorporated, that is licensed to operate in any town, USA. The dispensary has been in operation for 3 years and is only licensed to retail in edibles, vapes, and tinctures. The company practices membership sales model where customers receive discounts. The square footage of the retail space is 1,000 square feet, and the lease is 5 years long with the 2 years remaining. But the warehouse is not adjacent to the retail space and is in a separate location. The owner carries a business interruption insurance claims that is predicated on IRS approved and IRS compliant tax filing policy. The business has outstanding short-term note payable. The company has maintained good accounting records and has declared every single sale. The owner, one Jeffrey Malcolm, is a big grateful dad, Bob Marley and Fish fan, and he displays certain collectibles in the store associated with those musicians. The location had suffered a catastrophic act of God, act of higher power, and just bad luck. In September of the year, had to suspend its operation and relocate to new temporary facility during the period of restoration. The new location was larger and is more is more expensive. All right, let me have prospective financials for the dispensary, right? We have usually this work is done in a columnar fashion. We have a projection basis that provides historical available information for the 3 years of operation. We have our vapes, we have our tinctures, edibles, etc., etc. We have our cost of goods sold. We have our operating expenses, and we have our sales, general and administrative expenses, and we have our net income from operations based on the historical basis. Now, on the basis of this information, we created a projection that is anticipated to be based on the average growth trends of 10% for the revenue and 3% for the cost of goods sold, right? And this results in our projection basis, again, so far, very straightforward. Now, here is the actual result of the operation prior to the day of the event. And because it happened in September, again, where the assumption is the business only operated for 65% of its year. The actual intended and meant to reflect the results prior to the day off of the event. Now, the difference between the actual and the projection would represent our lost portion. So this is meant to represent lost sales that the business didn't get to make because of the loss event. This represents the portion of the expenses that the business didn't have to pay for because of the loss event, etc., etc. So far, so good. Now, as I mentioned, there have been some non-economic substance relevant and related activities. So, for example, the business had suffered loss of the collectibles, and there was a separate insurance coverage. So the collectibles were paid out for, but these numbers are not factored into the calculation. I just wanted to highlight them separately. Now, when we try to estimate our revenue, the delta, right, which represents the loss. However, not every revenue line item is allowed. Why? Well, we can't really include revenue from the revenue stream from the sale of flour because the business wasn't licensed for the sale of flour. So the 108,000 of lost revenues that would have been subject to the coverage had the business been licensed are now excluded and no longer part of the consideration. Similar goes to the cost of goods sold, right? We can't really factor in cost of goods sold for the flour because it wasn't licensed, and therefore the true cost of goods sold is significantly lower. Now we go through the expenses, and Renata just hold the questions here, and we would calculate those expenses as we normally would have, including operating expenses and sales and general administrative expenses, and that would give us the net income from operations. However, this is our starting point. We have the net income, we have the net income. If you recall, the formula for the net income method is the net income plus continuing expenses plus extra expenses gets us our loss number. So what would be the continuing expenses? When we look at the operating expenses, the business would still be subject to bank charges and fees. That would be a continuing expense. However, when we did the analysis, we realized that the business owner was leasing personal vehicle under the business expense. Well, that is not allowed. It would not be allowed. It's not part of the economic substance, so we wouldn't incorporate car and truck expenses into the calculation of our restored revenues. Insurance fees would be covered because they are part and customary. Accounting fees would be covered. Repairs and maintenance would not be covered. Obviously, the premise is no longer in operation, so there is really nothing to repair and maintain. Taxes and licenses would be covered. Utilities would be covered. However, there is a very distinct and very specific distinction here. Utilities would be covered up to the normal utilities that the business had suffered, plus any extra portion of the new utilities, and we will go through it as part of the extra expense. And Renata, here we come to your question: sales and general administrative expenses, advertising, meals, supplies, travel to various workshops, etc. None of these expenses would be included into the calculation of lost revenue because these expenses are subject to the IRC to ATE exclusion. And therefore we would highlight these expenses as part of the non-continuing expenses that are not subject to coverage. Does that address your question?
Where are the salaries? Where is the rent? Where is the salaries of the bartenders? Where is the rent?
Well, here is the payroll. Payroll is part of the continuing expense for the business
Mm-hmm.
interruption claim. Uh, Sales floor would not be covered. The old sales floor would not be covered. However, the new location, the temporary location that the business would need to be renting, would be covered as part of the extra expenses.
Okay.
Go ahead.
I have another question also on top of that. In terms of the SG&A expenses not being covered by insurance, and it's probably an insurance thing, but there's still financial losses, and they've still been suffered regardless of whether or not they're included in a tax calculation. It's interesting that it's not, because this isn't a tax item, this is an insurance item. It's interesting that would not be covered as part of the insurance.
What wouldn't be covered?
The SG&A expenses or whatever is not considered cost of goods sold, whatever is excluded from 280E, I think, is what you're saying would not be covered in a business interruption insurance claim.
Right.
But it's still a financial loss. It
is a financial loss. Yes, it's a cost of operating in the cannabis enterprise. Well, what can you do now? A regular business, a regular bar, probably would be able to show these expenses and have them reimbursed by the insurance. But these are the facts of life.
So I guess it's very important to actually go over the expenses that will be, because it looks like
Yes.
it's a lot of like room to interpretation and being very discretionate what's
Right.
included, what's not included.
Right.
Okay.
Now, this is a very high level example, right? But as part of the net income approach or the bottoms up approach, the focus is on the expenses, and every expense has to be justified, and every expense has to be explained what that might be, right? Again, to an earlier question, will the business suffered losses? Yes, sure, but look at that. The business also retailed in flour that they didn't have license for, and obviously none of that is included in the revenue calculation. Have they suffered losses? Absolutely. They've just shortchanged themselves by a huge chunk of their revenue. But again, it's not something that they would be able to claim. So.
The other question I wanted to ask also, when you were showing the trajectory, what if the business were on a downward trajectory? Would you then, you would, I guess, through the delta according to what, so if they were on a downward slope rather than an upward slope, you would project out the lower revenue.
Well, right. I mean, assuming business is not doing as great, you would still need to show the delta between the projection of what it would have been prior to the loss event and compare it to the performance post the event.
That's interesting because, like, if I'm projecting and I'm being very optimistic, obviously it's in my kind of benefit to project and being more optimistic and to show bigger delta. I'm curious how
Right.
then the insurance, like, are they like examining the assumptions? Why am I projecting a higher revenue? If it's just like,
That will be part and parcel. So there's always two parties to the to the negotiations, as it were. Insurance will have its own adjusters. Insurance will have its own professionals who would challenge the estimates provided by the business. Absolutely. I mean, there's going to be obviously a significant struggle or a fight, as it were, over each and every revenue item or each and every expense that the business claims should be reimbursable, and the insurance says, well, hold on, your revenues are overestimated, and your expenses also include something that we might not allow. So that's going to be part of the process. It incurred certain additional extra expenses. For example, legal or rather accounting fees went up because the business had to engage professionals to help them with estimates of their lost revenues. That would be an extra expense subject to coverage. Sales floor, new location. As I said, the old location is no longer reimbursable, but it's the temporary new location that will be subject to the reimbursement. Repairs and maintenance that had to be done to bring the old location up to the operational condition would be reimbursable. Utilities in excess of the customary utilities would also be reimbursable. And even though the business had engaged in additional advertising, maybe they've incurred more meals and entertainment expenses by buying food for their employees. Maybe there were other expenses, or maybe there were other supplies, office supplies that would be qualified as sales and general administrative expenses. Even though those also increased, none of them would be considered as part and component of the extra expenses. So last but not least, I know this is a very simplified, but under the net income method, going through we have our loss of net income. We add up our continuing expenses. We add up our extra expenses, and that would give us the potential business interruption loss that the insurance would be reimbursing the business for. And once we've provided that calculation, assuming this calculation, this breakdown is done on the behalf of the business, once this goes out to the insurance, that's where fun and games start, and each line item and the components of each line item will be questioned and challenged. So this concludes my presentation. Sorry for a slight technical snafu, and I really do appreciate all the discussion points and all the challenging discussion points that were raised. This presentation again is meant to broadly outline the process and the elements involved in business interruption claims, some of the mechanics and how to, but obviously it does not fit each and every scenario for each and every operator, and obviously it does not cover all possible insurance stipulations, which are again dependent on the geography, dependent on the type of the operator, and also customized more often than not.